Hello and welcome to Smart Finance Investor. Today, we're going to discuss a topic that's essential for every investor, whether you're just starting out or have been in the game for a while. We'll be uncovering the common mistakes to avoid in the stock market, so you can safeguard your investments and improve your financial success. Mistake 1. Lack of research. Investing without thorough research is akin to navigating uncharted waters without a map. This common mistake, the lack of research, is a fundamental blunder that can have dire consequences in the stock market. Many novice investors fall into this trap, driven by impatience or the desire to chase quick gains. They might buy a stock simply because it's trending on social media or because a friend mentioned it. However, this approach is speculative at best and can lead to significant losses. Effective research involves diving deep into a company's financials, understanding its business model, scrutinizing its growth prospects, and evaluating the competitive landscape. It also means staying informed about broader economic trends and market conditions. Lack of research can result in investing in companies with shaky financials, poor management, or no competitive advantage. It can expose investors to undue risks and make them susceptible to market volatility and downturns. To avoid this mistake, investors should commit to thorough research, develop a robust investment thesis, and only invest in companies they understand. This knowledge-based approach is the bedrock of successful investing and can lead to more informed and profitable decisions in the stock market. Mistake 2. Emotional investing. Emotions have a powerful grip on our decision-making, and in the realm of stock market investing, succumbing to emotions can be a costly mistake. Emotional investing, the second common mistake we'll explore, refers to making investment decisions based on feelings like fear and greed rather than rational analysis. Fear often manifests during market downturns. When stock prices plummet, investors may panic and sell their holdings to avoid further losses. This reactive behavior can lock in losses and prevent them from benefiting from eventual market recoveries. On the flip side, greed can lead to reckless risk-taking. Investors might chase after hot stocks or trends, buying at inflated prices without considering the underlying fundamentals. This can result in buying at the peak and suffering substantial losses when the bubble bursts. Emotional investing can create a cycle of buying high and selling low, which is the opposite of what successful investing entails. To overcome this mistake, investors must cultivate discipline, a long-term perspective, and the ability to detach from short-term market fluctuations. Developing a well-thought-out investment plan and sticking to it can help mitigate the influence of emotions, leading to more rational and profitable investment decisions. Mistake 3. Ignoring diversification. Ignoring diversification is a common yet critical mistake in stock market investing. This error occurs when investors allocate a significant portion of their capital to a single stock, sector, or asset class, neglecting the principle of spreading risk across a diversified portfolio. The consequences of ignoring diversification can be dire. Concentrating investments in one area leaves the portfolio highly vulnerable to adverse events that may disproportionately impact that sector or asset. For example, if you heavily invest in a single tech company and the tech sector experiences a downturn, your entire portfolio's value could plummet. Diversification, conversely, involves spreading investments across various sectors, industries, and asset classes. It's like not putting all your eggs in one basket. This strategy aims to mitigate risk because different assets may not move in sync. When one asset faces challenges, another may provide stability or even growth. Diversification doesn't eliminate risk entirely, but it helps strike a balance between risk and reward. While some investments may underperform, others can potentially outperform, providing a cushion against significant losses. To avoid this mistake, investors should prioritize diversification as a fundamental strategy to safeguard their investments and achieve more stable and predictable returns. Mistake 4. Trying to time the market. One of the most treacherous mistakes investors make is attempting to time the market. This entails trying to predict the precise moments to buy low and sell high based on short-term market movements. Market timing is a daunting endeavor, even for seasoned professionals, because it involves anticipating the unpredictable. Investors who fall into this trap often end up making decisions driven by emotion or speculation. They might sell in a panic during market downturns, fearing further losses, or buy into a soaring market, expecting prices to keep rising indefinitely. In both scenarios, they typically end up buying high and selling low, eroding their returns. Market timing is fraught with risks, and even the most experienced investors struggle to consistently get it right. Successful investing is about adopting a disciplined, long-term approach that aligns with your financial goals and risk tolerance. Rather than trying to time the market, it's more prudent to stay invested, diversify your portfolio, and periodically rebalance it based on your financial objectives. This strategy can help you weather market volatility and achieve more stable, predictable returns over the long term. Mistake 5. Overlooking risk tolerance. Overlooking risk tolerance is a significant mistake made by many investors. Risk tolerance refers to an individual's ability and willingness to withstand fluctuations in the value of their investments. This crucial aspect often gets neglected, leading to poor investment choices. When investors overlook their risk tolerance, they may unknowingly expose themselves to higher levels of risk than they can handle. For instance, an investor with a low risk tolerance may become anxious and make rash decisions during market downturns if their portfolio is primarily composed of high-risk assets. Determining your risk tolerance is a vital step in creating an investment strategy that aligns with your financial goals and emotional comfort. It involves considering factors like your financial objectives, investment horizon, and how you react to market fluctuations. A balanced approach that matches your risk tolerance can help you navigate the market's ups and downs with greater confidence and resilience, ultimately leading to more successful and less stressful investing. Mistake 6. Neglecting a clear strategy. One of the most common yet detrimental mistakes in stock market investing is neglecting to establish a clear investment strategy. This oversight often results in haphazard decision-making, inconsistent actions, and subpar performance. Neglecting a strategy can manifest in several ways. Some investors enter the market without defining their financial goals, risk tolerance, or investment horizon. Others lack a structured approach, buying and selling based on tips or market trends rather than a well-thought-out plan. Without a strategy, investors may chase after quick gains, succumb to fear during market downturns, or fall into the trap of impulsive trading. These behaviors can lead to significant losses and missed opportunities. A successful investment strategy involves setting clear, realistic goals, defining how you'll allocate your assets, and outlining when and why you'll make changes to your portfolio. It also considers factors like diversification, risk management, and a long-term perspective. By neglecting a strategy, investors essentially navigate the complex stock market without a roadmap, increasing the likelihood of costly detours. To avoid this mistake, take the time to develop a comprehensive investment plan that aligns with your financial objectives and risk tolerance. Having a strategy in place can help you stay focused, disciplined, and on course towards achieving your investment goals. Mistake 7. Chasing hot tips. Chasing hot tips is a grave mistake that often leads investors down a treacherous path in the stock market. This error involves making investment decisions based on unsolicited advice, rumors, or the latest market trends without conducting thorough research or analysis. Chasing hot tips can be particularly enticing when it appears that everyone else is profiting from a particular stock or investment strategy. However, this behavior is akin to gambling and rarely results in sustainable gains. The problem with hot tips is that they are often fleeting and speculative. By the time the information reaches the general public, it may already be too late to capitalize on the opportunity, and the risk of overpaying for an asset is high. Moreover, hot tips seldom come with a comprehensive understanding of the underlying fundamentals of the investment. Investors who chase such tips often lack critical information about the company, industry, or market conditions, leaving them ill-prepared for potential risks. To avoid this mistake, investors should prioritize their own research, due diligence, and a well-thought-out investment strategy. Avoiding these common mistakes can significantly improve your investment outcomes and help you build a more secure financial future. Remember, successful investing requires discipline, research, and a long-term perspective. If you found this video helpful, don't forget to like, share, and subscribe for more insightful content. Thank you for joining us today on Smart Finance Investor. Until next time, happy investing.